Vanguard's Principles for Successful Investing, CBS News. cbsnews.com/CBS Evening News /CBS This Morning /48 Hours /60 Minutes /Sunday Morning /Face the Nation. Markets, Investing, Tech, Leadership, Small Business, Saving, Spending, Retirement Video. Log in, join cbsnews.com, sign in with profile. Manage my newsletter subscriptions, update my email address, change my password, log out. Get by Larry Swidrow /Money Watch /September 13, 2013, 6:55 a.m. Vanguard's Principles for Successful Investing. Money Watch. Vanguard is the leader in providing low-cost index funds to retail investors. In addition to its funds, the firm's research department provides investors with a wealth of information on how capital markets really work. If you pay attention to their advice, instead of the persistent flow of investment porn put out by Wall Street and most of the financial media, you'll find your way to the winning investment strategy. Readers of my books and blog know that my writings emphasize the academic research and getting investors to focus their efforts and attention on the things they actually can control, the amount and type of risk they take, diversifying the risks they choose to take as much as possible, keeping costs low and tax efficiency high, instead of trying to manage returns. For them, the recommendations of a new paper from Vanguard will sound very familiar. Dieting and Investing, Simple, but Not Easy. Why investors shouldn't follow their gut. Why do so many investors ignore the evidence? The paper, which outlines Vanguard's core investment beliefs, begins by noting that the overarching theme running through the investment guidance they provide to clients is to focus on those things within your control. They then note that, unfortunately, too many investors focus on the markets, the economy, manager ratings, or the performance of an individual security or strategy, overlooking the fundamental principles that we believe can give them the best chance of success. While taking the time to read the full paper would be one of the best investments you could make, the following is offered as a short summary of the 4 major themes covered and the advice offered. Goals. Because a plan should be tailored to your unique situation, the process should begin by aligning your objectives as well as any significant constraints. It should be long-term and designed to endure through bull and bear markets, and be flexible enough to adjust for unexpected events along the way, what I've referred to as having a plan B. Once the plan is in place, the investor should evaluate it at regular intervals. They know that without a plan, investors can be tempted to build a portfolio based on transitory factors such as fund ratings, something that can amount to a buy high, sell low strategy. They emphasize that a sound investment plan can help the investor to avoid such behavior, because it demonstrates the purpose and value of asset allocation, diversification and rebalancing. It also helps the investor to stay focused on intended contribution and spending rates. Balance. The investment strategy should emphasize broad global diversification across asset classes and avoid exposure to unnecessary risks. It should also be built upon reasonable expectations for risk and returns. They also emphasize that while stocks are risky, having too low an allocation to them can create other risks, increasing the risk of not achieving your financial and life goals. They also note that while historical returns can provide perspective, it may not be appropriate to simply project past returns into the future. Current bond yields and stock market valuations, price-to-earnings ratios should be considered to make sure that return expectations are realistic. The implication is that investors may need to adjust their asset allocation assumptions and contribution/spending plans to meet a future objective that could previously have seemed easily achievable based on historical values alone. Cost. While you can't control the markets or returns, you can control costs and tax efficiency. And the evidence is clear that lower cost, passively managed investments outperform higher cost active alternatives. You should also pay attention to asset location, with the objective being to hold relatively tax-efficient investments, such as broad market stock index funds or ETFs, in taxable accounts, while keeping tax-inefficient investments, such as taxable bonds and REITs, in retirement accounts. Discipline. Both bull and bear markets create emotions that lead to bad investor behavior. They can cause investors to make impulsive decisions or, conversely, become paralyzed, unable to implement an investment strategy or to rebalance the portfolio as needed. Discipline and perspective are the qualities that can help investors remain committed to their long-term investment programs through periods of market uncertainty.